This video is brought to you by togetherbudget.com. So, let's dive into the basics of ETFs. Essentially, an exchange-traded fund is a type of investment fund that's traded on a stock exchange just like individual stocks.
That makes sense. I mean, it's like a basket of stocks, right?
Exactly. Ding ding ding. It's a way to pull together smaller investments into a single security that tracks the performance of an underlying index or sector.
Oh my goodness, exactly. So it's like owning a piece of the market, but not actually having to hold all those individual stocks.
One of the key benefits of ETFs is their flexibility. You can buy or sell shares throughout the trading day, just like individual stocks.
That's a big plus. I mean, with mutual funds you're locked in for a year, or something.
Ka-ching. That's not entirely accurate. Mutual funds do have some flexibility, but ETFs offer the same flexibility as individual stocks.
Haha, that is wild. I didn't know that about mutual funds.
Another important aspect of ETFs is their transparency. You know exactly what you're getting with an ETF, because the holdings are disclosed daily.
I love that. It's like having a crystal ball into the market, isn't it?
Phew. I wouldn't say that exactly. But you do have access to real-time data on the underlying holdings.
Heh, true. That's reassuring, at least.
So, let's dive into the benefits of investing in ETFs. One of the most significant advantages is diversification.
That's right. By investing in an ETF, you're essentially buying a tiny piece of every stock within that fund.
Exactly. It's like getting a diversified portfolio without having to manually pick and choose individual stocks.
And the best part? You don't have to worry about overinvesting in any one particular stock, which can be a major risk.
Ding ding ding. That's the beauty of ETFs, they're like a set-it-and-forget-it investment solution.
Yeah, and it's also great for investors who don't have a lot of time or expertise to manage their portfolio.
Of course, there are some trade-offs. But overall, diversification is one of the most significant benefits of ETFs.
Absolutely. And speaking of trade-offs,
another major benefit of ETFs is liquidity. You can buy and sell them easily throughout the trading day.
That's right. Unlike mutual funds, which often trade at a discount or premium to their net asset value (NAV), ETFs are priced in real time.
And that's not all, because ETFs are traded on an exchange, you can sell them quickly if needed.
Phew. That peace of mind is priceless for investors who need access to their money fast.
It's like having a fire extinguisher in the stock market, it's there when you need it, and it can help put out any financial fires that might arise.
Haha, I love that analogy. And finally,
one of the most significant benefits of ETFs is their low costs, often lower than actively managed funds or individual stocks.
Oh my goodness, exactly. No-load fees and low expense ratios make ETFs a more cost-effective option for long-term investors. So, let's summarize the benefits of ETFs: diversification, liquidity, and low costs.
Ka-ching. That's a winning combination right there.
Exactly. And I think it's worth noting that these benefits can be especially attractive to beginners or those who are new to investing in general.
That's absolutely true. ETFs offer a level of simplicity and ease of use that makes them an excellent choice for anyone looking to get started with investing.
Well said. And I think we've covered the benefits of ETFs pretty thoroughly in this episode.
Agreed. It's been a pleasure chatting with you about ETFs, they're truly a game changer for investors. So, let's dive into the different types of ETFs. We've got index funds, actively managed funds, and leveraged/inverse funds.
That's right. And I think it's essential to understand the differences between them. I mean, who doesn't love a good index fund? Laughs.
Well, they're a great place to start. Index funds track a specific market index, like the S&P 500 or the Dow Jones. They're like the set-it-and-forget-it option.
Exactly. And one of the main benefits is that they're usually very low cost. I mean, you can't get much cheaper than buying a small piece of the entire market catching.
That's true. And because they're designed to track an index, they tend to be relatively stable and less volatile.
Now, let's talk about actively managed funds. These are like the investing pros of the ETF world.
Yeah. Actively managed funds have a fund manager who tries to beat the market by making tactical decisions about which stocks or bonds to buy and sell.
Exactly. And they can be a bit riskier than index funds because you're putting your faith in one person's investment skills. Whoosh.
That's right. But if the fund manager is good, you might see better returns over time. Now, let's talk about leveraged and inverse ETFs. These are like the high-octane option in the world of ETFs.
Yeah. Leveraged and inverse funds use complex formulas to amplify returns or reverse market performance.
That's right. But they're not for the faint of heart. They can be very volatile and even more expensive than other types of ETFs.
Exactly. And you have to be extremely careful when using them, because they can blow up in your face if you're not paying attention.
So, let's talk about choosing the right ETF for your investment goals. It can be overwhelming with so many options out there.
I know what you mean. I feel like I'm drowning in a sea of acronyms and ticker symbols.
Ka-ching! That's exactly the feeling I want to help you avoid. First, let's talk about your investment goals. Are you looking for long-term growth or income generation?
Okay, so let's say I want to invest in technology. How do I choose between an ETF that tracks the Nasdaq or one that focuses on cloud computing?
Great question. Ding ding ding. You see, it's like choosing a restaurant for dinner. If you want the whole shebang, go with the broad market ETF. But if you're looking for something more specific, like vegan options, then choose the cloud computing ETF.
That is wild. Okay, so what's the trade-off between these two options?
Now that we've discussed some of the key factors to consider, let's talk about something important: fees. Phew. ETFs can have a wide range in terms of expense ratios.
Oh my goodness, exactly. I've heard horror stories about people getting ripped off by high-fee funds.
Yeah, it's like paying for a fancy coffee when you could get the same thing at Dunkin' Donuts. Whoosh! You want to save that money for your investments, not waste it on unnecessary fees. One of the most common mistakes people make when investing in ETFs is not doing their due diligence on the underlying holdings.
That's so true. I mean, we've all been guilty of just buying a popular ETF without knowing what's inside it.
Ka-ching! Of course, we do. It's like putting blind faith in the fund manager to make all the right decisions.
Exactly. And that's a recipe for disaster. So, what are some red flags we should look out for when choosing an ETF?
Another mistake people make is not considering the trading costs associated with buying and selling ETFs.
Oh my goodness, exactly. I mean, we've all heard about the importance of minimizing trading fees, but it's easy to overlook them when investing in ETFs.
Ding ding ding. That's because ETF trading fees can add up quickly, especially for frequent traders.
So, how can we minimize these costs and make the most out of our ETF investments?
Lastly, people often neglect to rebalance their ETF portfolios over time.
Whoosh. That's like trying to hold water in a sieve, it just won't work.
Rebalancing ensures that your portfolio remains aligned with your investment goals and risk tolerance.
So, what strategies can we use to stay on track and maintain an optimal ETF portfolio?
So, let's dive into tax-efficient ETF strategies. The goal here is to minimize taxes while maximizing returns.
Exactly. And I think one of the most effective ways to do that is by using low turnover funds.
Phew. The joys of tax loss harvesting. It's like finding a discount coupon for your investment portfolio.
That is wild. But seriously, it can be a huge boon for investors who have realized losses in their portfolio. Now, let's talk about the importance of tax-efficient ETFs. What are some of your favorite low-turnover funds?
Ah, that's a great question. I'm a big fan of Vanguard's Total Stock Market Index Fund (VTI). It's a core holding in many portfolios. This tutorial is brought to you by Malik Abwalzait.